The pattern of wealth transfer during economic crises has repeated so consistently that it resembles a predictable cycle. In 2008, middle-class families saw more than $16 trillion in household wealth wiped out almost overnight. Most of this wealth was tied to homes and retirement accounts that were highly sensitive to falling asset prices. When the housing bubble burst, millions of families suddenly faced mortgage payments they could not afford. Adjustable rate loans reset to dramatically higher monthly costs. Foreclosures surged across the country. Every foreclosure represented not only a lost home, but years of savings and equity erased. That equity did not vanish from the system. It became an opportunity for large financial institutions to acquire homes at massive discounts. Blackstone and other firms bought tens of thousands of foreclosed homes at prices far below previous market values. Average homeowners had no ability to compete with these cash buyers during auctions. Meanwhile, the stock market collapsed by more than half. Retirement accounts that families had built over decades lost enormous portions of their value. Fear and financial pressure forced millions to sell at the worst possible moment. Many sold because they needed immediate cash to survive after job losses. Others sold because their brokers liquidated positions automatically when margin requirements were breached. Early withdrawals from 401k accounts became common despite heavy penalties. These sales locked in losses permanently. At the same time, wealthy investors were positioned entirely differently. They had sold portions of their holdings earlier when valuations were stretched. They held large cash reserves as markets entered the downturn. They had no fear of losing jobs or income, and they were waiting for opportunities. Warren Buffett demonstrated the power of liquidity during a crisis. He negotiated special deals with banks that offered double-digit dividends and stock warrants. No average investor received terms even remotely similar. Hedge funds also exploited the opportunity. They bought distressed mortgage-backed securities at pennies on the dollar. They knew those assets would eventually recover or settle favorably. Their long timelines allowed them to wait for that recovery. Middle-class families did not have that luxury. Their financial structure required immediate stability. Their income was essential to support debt obligations. When income disappeared, they were forced to liquidate. This dynamic magnified losses for ordinary families. The Federal Reserve intervened aggressively to stabilize financial markets. Rates were cut to zero to make borrowing cheaper. Trillions were injected into the system through quantitative easing. These actions inflated asset prices rapidly. The rebound in stocks benefited those who had remained invested or who bought aggressively near the bottom. Wealthy investors had the ability and the confidence to do exactly that. Middle-class families who had sold at the bottom missed the recovery entirely. The homes they lost became rental properties owned by large private equity firms. The stocks they sold recovered and climbed without them. The wealth that seemed to evaporate in 2008 reappeared on the balance sheets of the wealthiest Americans. The middle class then spent years repairing credit scores damaged by foreclosure. Many struggled for nearly a decade to rebuild emergency savings. The wealthy experienced a very different decade. They saw asset values expand dramatically during the longest bull market in history. The pattern repeated again during the 2020 pandemic crash. The economy shut down rapidly and 22 million workers lost their jobs within weeks. Small businesses that were financially healthy suddenly could not operate. Most did not survive the shutdowns. Owners lost years of equity and stability. Without income, many families liquidated retirement savings to survive. The stock market fell 35% in just 3 weeks. Panic selling dominated retail investor behavior. Yet wealthy investors did not panic sell. They bought aggressively at the lows. They had the cash to act when others were forced to retreat. The Federal Reserve responded with unprecedented monetary support. $6 trillion in liquidity flooded financial markets. Corporate bonds were purchased in massive quantities to stabilize credit. This intervention caused stocks to rebound at record speed. Asset owners benefited enormously from this recovery. Billionaire net worth surged by trillions during the pandemic period. These gains did not come from new innovations. They came from holding assets that the Fed directly inflated. Middle-class families who liquidated during the crash did not participate in this rebound. The structural differences between classes determined outcomes. Families living paycheck to paycheck cannot ride out a downturn. The wealth transfer cycle functions through a repeating series of phases that appear different on the surface, but operate with the same underlying mechanics. The first phase begins with the creation of a bubble driven by easy money and abundant credit. Low interest rates make borrowing extremely cheap. Consumers borrow to buy homes, cars, and stocks. Businesses borrow to expand operations and acquire competitors. Investors borrow to increase leverage and amplify gains. This credit expansion pushes asset prices higher. Rising prices create a feeling of confidence across the economy. People begin to believe the good times will continue indefinitely. Cheap credit leads to speculation that would not occur under normal financial conditions. Homebuyers stretch for larger houses at higher prices. Investors chase stocks that have already risen for years. Banks loosen lending standards because defaults appear unlikely. Middle-class families feel wealthier because their home values rise. They take on more debt, believing rising prices will protect them. The wealthy behave differently during this phase. They quietly reduce exposure to inflated assets. They take profits while enthusiasm is still high. They accumulate cash because they know bubbles do not last. Most people interpret this early selling as a sign of caution they do not feel. As the bubble expands, credit quality declines. Banks issue riskier loans to keep profits growing. People who should not borrow are encouraged to borrow anyway. This fuels the second phase when the Federal Reserve begins tightening. Rate hikes increase the cost of borrowing. Higher rates slow down the economy. Monthly payments rise across credit cards, mortgages, and business loans, and investors with leveraged positions face greater pressure. The psychological tone of the market shifts from confidence to caution. At first, the changes seem minor, but tightening builds pressure throughout the system. The weakest borrowers start to default. Companies with heavy debt loads struggle to refinance. Financial markets begin to show cracks that most people ignore. Asset prices stop rising as quickly. Some sectors begin to fall. The wealthy observe these shifts and continue reducing risk. The middle class continues holding assets purchased at inflated prices. By the time tightening becomes painful, it is already too late for most households to adjust. The third phase begins when a triggering event exposes the system's fragility. The exact trigger is always different. In one cycle, it may be housing. In another, it may be technology stocks. In another, it may be commercial real estate or credit markets. But the underlying issue is the same. Too much leverage meets rising financial pressure. Asset prices begin to fall suddenly. Margin calls force investors to sell positions immediately. Companies with weak balance sheets collapse. Layoffs rise as businesses scramble to cut costs. Consumers lose income and struggle to meet obligations. Fear spreads across financial markets. People sell not because they want to, but because they must. This is the moment when the forced selling phase takes over. Retirement accounts are liquidated to cover urgent expenses. Homes are sold under distress or lost to foreclosure. Stocks are dumped at the worst possible prices. The wealthy who were holding cash begin preparing to buy. The fourth phase is the actual transfer of wealth. Distressed assets flood the market at fire sale prices. Homes that sold for $400,000 suddenly sell for $200,000. Stocks trading at record highs collapse to multi-year lows. Businesses with real long-term value become temporarily cheap. Large investors enter the market with confidence. They acquire assets aggressively while fear dominates public sentiment. Private equity firms expand their portfolios rapidly. Hedge funds take large positions in undervalued sectors. Cash-rich individuals buy quality stocks and real estate at deep discounts. These purchases shift ownership from stressed households to capital-rich investors. While the middle class is shrinking its asset base, the wealthy are expanding theirs. The transfer happens quietly yet massively. Once the selling exhaustion ends, financial markets stabilize. This leads directly into the fifth phase. The Federal Reserve steps in with intervention to prevent deeper collapse. Rates are cut sharply to stimulate borrowing. Liquidity is injected to support financial institutions. Investors interpret these actions as a signal to re-enter markets. Asset prices begin to recover. The recovery is strongest in the very assets that wealthy investors purchased during the downturn. Homes appreciate rapidly once demand returns. Stocks rebound sharply from their lows. Business valuations climb as credit conditions improve. The wealthy watch their newly acquired assets rise in value. The middle class watches prices rise after they have already sold. The recovery phase amplifies the transfer that occurred during the downturn. When the cycle completes, the wealthy own more assets at higher valuations. The middle class owns fewer assets purchased at higher prices and sold at lower ones. This cycle repeats because the incentives that create it never change. Cheap credit fuels bubbles. Tightening exposes weaknesses. Crashes force selling. Cash enables opportunistic buying. Intervention reinflates markets. Each loop widens the gap between those forced to react and those prepared to act. The signs that the historical crisis cycle is repeating have been building for several years, as the conditions that typically precede a major downturn have been appearing one by one as between 2020 and 2022. The market experienced one of the fastest asset booms in history as stocks reached valuations that far exceeded long-term averages, while real estate prices rose at the fastest pace ever recorded in many regions. And cheap borrowing costs encouraged people to stretch for bigger homes and larger investments as retail investors entered the market at record rates, and speculation increased across meme stocks and cryptocurrencies, and many believe the boom would continue indefinitely, which is the same type of sentiment that usually appears near the top of a cycle, as household debt began climbing to all-time highs and credit card balances increased rapidly as inflation raised the cost of living, while auto loans reached record levels with longer and riskier terms, and mortgage debt expanded far faster than incomes leaving the average American more financially stretched, despite rising asset prices, which left the middle class especially vulnerable to any economic shock, while wealthy investors began behaving differently and started selling portions of their positions, while the public continued buying as corporate insiders increased stock sales during the peak valuation months, and Buffett allowed Berkshire's cash pile to grow to historic levels, while cash holdings for large hedge funds surged as well, showing a clear shift toward caution and signaling that the most informed market participants were preparing for turbulence as the Federal Reserve signaled that interest rate hikes were coming, because inflation had reached levels the Fed could not ignore, so rate hikes began aggressively in 2022, marking the fastest tightening cycle since the early 1980s as borrowing costs rose sharply for households and businesses, while monthly payments on mortgages jumped for new buyers, and credit card interest rates climbed to painful highs, causing small businesses reliant on loans to feel immediate financial pressure, as consumers cut back on discretionary spending and corporate earnings started to weaken, while layoffs began to increase in tech companies first. And other sectors soon followed as demand slowed, and by this time, markets had lost much of their artificial support from low rates. So asset prices started correcting across multiple categories as stocks entered a bear market, and cryptocurrencies saw massive drawdowns from their peaks, while housing activity slowed dramatically as mortgage rates surged and commercial real estate emerged as a major point of concern, with many office buildings struggling with low occupancy, as remote work permanently changed demand for office space and billions in loans tied to these buildings approached maturity, while higher rates made refinancing extremely difficult and owners faced the possibility of surrendering properties to lenders, as regional banks had large exposure to these commercial loans, and several banks already collapsed due to interest rate stress, while remaining regional banks faced growing pressure as small business lending slowed while banks tried to preserve capital. And these cracks resembled the early fragility seen before previous crises, as consumer savings that had accumulated during the pandemic were shrinking, while inflation eroded purchasing power month by month, and many families returned to using credit to cover basic expenses, as delinquencies on auto loans and credit cards began climbing, which reflected early stages of financial strain as the middle class became less capable of handling unexpected shocks, while wealthy investors increased their cash positions even more and began selling portions of their real estate portfolios while moving into safer, short-term treasury bills as they prepared for opportunities that would appear when markets declined further, while insider selling continued at elevated levels, and executives at major companies sold shares while publicly projecting optimism, creating a divergence between messaging and behavior that mirrored past late cycle periods, as large institutions paused many investment plans while private equity firms slowed acquisitions and waited for better pricing. And venture capital funding dropped sharply after years of excess, as the overall environment shifted from expansion to contraction, and confidence in the economy weakened steadily, while the yield curve remained deeply inverted for an unusually long time, which historically often precedes recessions, as manufacturing activity contracted across multiple regions, and shipping volumes declined as global demand softened, while these slowdowns pointed toward economic stress building quietly as household budgets tightened while wages lagged behind inflation and rent prices remained high, even as other costs fluctuated, and energy prices experienced volatility that added uncertainty, causing people to postpone large purchases, such as cars and homes, which reduced spending and created further pressure on businesses as companies responded by cutting hiring plans, and some firms initiated rounds of layoffs to protect profitability, creating a feedback loop that weakened consumer confidence further as housing affordability dropped to the worst levels in decades, and first-time buyers were largely priced out of the market, while sellers faced fewer qualified buyers and price reductions became more common in several regions, as commercial landlords offered concessions to attract tenants, and investment properties delivered lower returns, signaling broader stress spreading throughout the real estate sector, while financial markets reacted with increased volatility as sudden swings reflected uncertainty and lack of conviction, while investors moved money rapidly between risk assets and safe havens, as retail sentiment swung sharply based on news headlines, while institutional investors maintained caution because they expected greater downside before any true recovery as credit markets tightened while bond yields rose, and companies with weaker balance sheets faced refinancing challenges as defaults increased in corporate debt segments, mirroring early patterns seen before previous recessions, while consumer surveys showed growing pessimism about future conditions as people expressed concern about job security and businesses expressed concern about future demand, as the overall tone shifted from optimism to anxiety, which is a psychological transition common before a downturn accelerates, as household emergency savings declined significantly and unexpected expenses became harder to manage, while bankruptcies increased among individuals and small businesses, and lenders reduced approval rates for new credit applications, which further tightened conditions for the middle class, as wealth concentration continued to increase while asset owners retained control, and the middle class became more dependent on debt to maintain living standards as the environment resembled late-phase tightening seen before major crises. And the stage appeared, set for the next part of the economic cycle, as the conditions that usually precede forced selling were already forming, and the indicators that signal cracks in the system were appearing across sectors as the decisions of wealthy investors pointed toward preparation rather than confidence, and the average household carried far more vulnerability than resilience, while financial pressure built steadily beneath the surface as these accumulating stresses suggested the cycle was approaching. Its breaking point and the repeating pattern from previous crises appeared ready to unfold again. The next crisis scenario becomes clearer when the repeating mechanics of past downturns are applied to today's conditions. Every major cycle begins with excessive leverage across households, corporations, and financial institutions. That leverage becomes fragile when interest rates rise faster than anticipated. Today, the economy is heavily exposed to high rates after more than a decade of dependence on cheap money. Many borrowers lock themselves into obligations they could only afford under the low-rate environment that no longer exists. This creates a structural vulnerability that becomes most visible when economic conditions begin to deteriorate. If a sharp downturn emerges, the first shock would likely appear in the stock market. Valuations remain elevated relative to long-term earnings growth. A contraction in earnings, combined with reduced liquidity, could cause a rapid repricing. A large market sell-off would trigger margin calls across countless leveraged accounts. Margin calls force investors to liquidate holdings without regard for price. This mechanical selling accelerates market declines and spreads panic. Retail investors typically react emotionally during these moments. They tend to sell in a rush to preserve what remains of their portfolios. Institutional investors with cash reserves instead prepare to buy as prices collapse. As equities fall, pension funds grow concerned about funding ratios. These funds may rebalance into bonds, which can exacerbate selling pressure in stocks. Large drops in retirement accounts create fear among households already financially stretched. This fear reduces consumer spending, which further pressures corporate earnings. Declining earnings produce more layoffs as companies attempt to stabilize margins. Rising layoffs reduce income for millions of families. Households dependent on stable paychecks immediately feel the consequences. Those without savings must rely on credit to cover basic expenses. As expenses grow and income falls, credit card balances spike. High interest rates make these balances extremely difficult to manage. Delinquencies climb, and lenders tighten approval standards. This tightening cuts off access to credit for many families when they need it most. Without credit or savings, households begin liquidating asset holdings. This creates the environment for forced selling. Forced selling includes retirement accounts that must be cashed out to cover living expenses. It includes brokerage accounts liquidated during market declines. It includes investments sold at losses because families cannot endure further uncertainty. These liquidations lock in losses and remove the opportunity to benefit from any recovery. At the same time, the real estate market faces immense pressure. Residential homeowners who purchased with low down payments face declining equity. If home prices fall enough, some owners may owe more than their homes are worth. This creates conditions for distressed sales and foreclosures. Foreclosures become more likely when job losses and high interest burdens collide. Banks begin repossessing properties and placing them back onto the market. The increase in supply pushes prices lower, which accelerates the decline. Commercial real estate faces an even more severe crisis. Office buildings with high vacancy rates struggle to generate revenue. Many owners cannot refinance loans at current interest rates. Billions of dollars in commercial loans reach maturity over the next several years. These loans must be refinanced at rates far higher than the original terms. For some borrowers, refinancing is impossible because the property value has fallen too much. In such cases, lenders may take control of buildings at massive losses. Regional banks hold a large portion of these commercial real estate loans. Losses in this sector weaken their balance sheets significantly. A wave of defaults could cause several regional banks to become insolvent. Bank insolvency undermines confidence in the banking system. Even insured deposits may be moved by anxious customers. This creates the possibility of localized bank runs. The government may intervene, but not all institutions can be rescued without consequence. These disruptions tighten financial conditions across the economy. Small businesses that rely on regional banks struggle to secure loans. Some businesses shut down due to lack of credit and declining sales. This increases unemployment further and adds pressure to communities dependent on small business activity. As layoffs rise, delinquencies across mortgages, auto loans, and credit cards climb. This strain feeds back into the banking system, creating additional losses. Investors observing this deterioration withdraw capital from risk assets. They move into short-term bonds or money market funds as a protective measure. These defensive moves reduce liquidity in the stock market. Lower liquidity makes market declines sharper and more volatile. The cycle of fear intensifies as negative news becomes more frequent. Households already stretched begin selling personal assets to stay afloat. The psychological burden of financial stress reduces consumer confidence dramatically. Confidence collapses faster than most economic variables. When confidence collapses, spending slows sharply. Slowing spending forces more businesses to cut costs even further. This feedback loop deepens the recession and accelerates the contraction. During this environment, the wealthy behave entirely differently. They enter the downturn with large cash reserves and minimal leverage. They do not face the forced selling that burdens middle-class families. Instead, they view every sharp decline as an opportunity. As real estate prices crash, wealthy buyers acquire properties at discounted valuations. Private equity firms raise funds specifically to buy distressed assets. They target apartment complexes, warehouses, office buildings, and single-family homes. These purchases transfer ownership from stressed borrowers to well-financed investors. In the stock market, wealthy investors accumulate shares of strong companies at depressed prices. They buy shares in sectors temporarily damaged by the recession, but fundamentally sound. They negotiate favorable terms in private investments unavailable to the general public. Hedge funds purchase distressed corporate bonds and profit when conditions stabilize. Cash reserves give them leverage to dictate terms during negotiations. Meanwhile, ordinary households cannot buy assets because they are still recovering from losses. The wealthy expand their holdings while the middle class contracts theirs. Federal Reserve intervention eventually arrives to stabilize financial markets. Rate cuts are implemented to ease borrowing pressures. Liquidity injections aim to prevent a deeper collapse in banking and credit. These policy moves cause asset prices to rebound gradually. The rebound accelerates as confidence slowly returns to financial markets. Asset prices rise the fastest in the categories that wealthy investors bought during the downturn. Houses purchased at distressed prices climb rapidly in value. Stocks purchased near the bottom produce substantial gains. Private equity exits their investments at high multiples once valuations recover. The middle class watches the recovery from the sidelines because they sold earlier. They cannot re-enter the market at the lows because they lacked the capital to hold. By the time stability returns, asset prices are already far higher. This dynamic compounds the disparity created during the forced selling phase. The wealthy emerge with significantly more ownership of the productive assets of the economy. The middle class emerges with fewer assets and more debt. This difference in outcomes constitutes the core of the projected $30 to $50 trillion wealth transfer. The transfer is not theoretical. It is a mathematical result of who sells during the crisis and who buys during the crisis. Every cycle has produced the same directional outcome, even if the details differ. Those with liquidity convert fear into opportunity. Those without liquidity convert fear into financial loss. The next crisis scenario would amplify this pattern due to the size of today's imbalances. High household debt, heavy reliance on credit, and elevated asset prices make the middle class especially vulnerable. High cash reserves, strong balance sheets, and diversified portfolios give the wealthy exceptional advantage. When the downturn reaches its deepest point, the difference between these two groups becomes unmistakable. The conditions are aligning for this scenario to unfold as they have in past cycles. The scale will likely be larger because the entire system is larger. The consequences will follow the same logic that has governed every previous period of economic stress.